Now speaking, Steve Winokur, Vice President, Investor Relations. Welcome to GE's second quarter 23 earnings call. I'm joined by Chairman and CEO, Larry Culp, and CFO, Carolina Dybeck-Happ. GE Aerospace CFO, Rahul Ghai, who will also assume the role of GE CFO in September, will join us for Q&A. Now speaking, Larry Culp, Chairman and Chief Executive Officer. Good morning everyone. GE had a strong quarter with double-digit growth in orders, revenue, operating profit, and cash. This was driven by services strength, robust market demand, and the lean transformation within our more focused businesses. Earnings have now surpassed our full year 2022 results. GE Aerospace is growing rapidly as we execute on the ramp for our customers, and GE Vernova is strengthening pre-spin, with record orders and improving profitability at renewable energy and continued margin expansion at power. Based on this performance, we are raising full-year guidance. At the Paris Air Show, GE Aerospace shared their vision to define flight for today, tomorrow, and the future. CFM's RISE demonstrator program aims to reduce fuel consumption and CO2 emissions by at least 20%. We are also seeing lean's impact in our offshore wind facility in Saint-Nazaire, where the team has reduced cycle times to assemble nacelle roofs by nearly 50%. Services represent about 70% of GE Aerospace revenue and about half of GE Vernova revenue. We are advancing toward the launches of our 3 independent companies next year. We welcome Rahul to his additional role as GE CFO this fall. We thank Carolina for her many contributions and wish her well in her future endeavors. Now speaking, Carolina Happ, Chief Financial Officer. Thanks, Larry. In the second quarter, GE delivered double-digit growth across all headline metrics. Orders increased 58%, with equipment up significantly, led by renewables and aerospace also up with solid defense engine orders. Revenue increased 19%, with both equipment and services up. Aerospace led the way as LEAP engine deliveries nearly doubled and services grew. Renewables also grew, led by onshore wind and grid, with improved pricing. Adjusted margin expanded to 160 basis points driven by volume, price, and productivity. This resulted in adjusted EPS of 68 cents, nearly double what was delivered last year. Free cash flow was $415 million, more than double what was delivered last year. Corporate costs were up year-over-year, primarily driven by non-repeat of 2022 timing benefits. GE partially monetized its GE Healthcare stake and announced that it will call the remainder of the outstanding GE preferred stock in September. A charge of $1 billion was recorded in discontinued operations due to a settlement program for a Polish mortgage portfolio. For the full year, GE is now expecting revenue growth in the low double-digit range, $2.10 to $2.30 of adjusted EPS, and $4.1 billion to $4.6 billion of free cash flow. Now speaking, Larry Culp, Chairman and Chief Executive Officer. GE Aerospace showcased industry-leading solutions for both commercial and defense across propulsion, systems, and services this quarter. The defense team signed a historic MO with Hindustan Aeronautics Limited to produce jet fighter engines for the Indian Air Force, and the commercial business secured major deals with Riyadh Air, Jet2, and more. GE Aerospace is using a lean tool called Plan for Every Part to implement pull and improve delivery, resulting in a 35% increase in engine deliveries in the second quarter, including a 40% improvement in T700 from a 25% reduction in lead times. Orders were up 37% with strength in commercial services and defense, and revenue was up 28% with equipment growing at double the services rate. Profit improved close to $350 million or nearly 30%. Margins contracted 30 basis points organically. Departures have almost returned to pre-COVID levels. LEAP deliveries were up over 80% year-over-year and over 10% sequentially, and commercial services revenue grew over 30%. Defense orders more than doubled and engine output increased with units up over 70%. GE Vernova saw long-term growth tailwinds driven by the need for more sustainable, affordable, resilient energy, along with energy security. Market demand broke record orders, led by grid with 2 more large HVDC projects. Onshore wind was strong again, led by North American equipment growing more than threefold. Revenue grew 27% organically, driven by higher equipment deliveries across both wind and grid. Profit improved year-over-year and sequentially for the second consecutive quarter. GE Power delivered solid results and reliable earnings and cash flow, providing critical support for future growth at GE Vernova. Utilization grew at a low single-digit rate this quarter, and orders grew high single digits with strength from gas power transactional services. Services continued to grow and there were higher HOD deliveries. Price, productivity, and higher contractual outage volume on heavy-duty units more than offset inflation. For the year, GE Vernova is expecting mid-single-digit revenue growth and a negative $400 million to a negative $100 million in profit, an improvement of almost $800 million year-over-year at the midpoint. GE Power is expecting low single-digit revenue growth and even better profit versus 2022. Jefferies analyst Sheila Kahyaoglu inquired, what are the dynamics that caused Aero margins to contract from 18.9 in H1 to 18.5 for the full year? Larry Culp replied, Sheila, you're right. There is a mixed dynamic in play as equipment revenues increase while services remain steady. Rahul, can you provide more insight on this? Rahul Guy replied, thanks, Larry and Sheila. The second quarter was a great success with 28% organic growth, commercial engines up more than 50%, services with 30% plus growth, and defense recovering to double-digit revenue growth for the first half. Profit was up more than 30% year-over-year with margin expansion. This gave us the confidence to raise the full-year outlook, increasing profit by $1 billion at the midpoint of the guide. We are also raising the commercial OI outlook from approximately 20 to mid to high 20s. The key driver of the sequential growth between first half and second half is commercial OI, which is up 60%. Spare parts installs are also increasing as a percentage of total shipments in the second half of the year, resulting in a step down in margin. Despite this, it will still be a really good year with margin expansion and profit growth of $1 billion. Larry Culp replied, we are pleased with the favorable year-over-year orders in our offshore business. While there may have been some concerns about the overall pricing dynamic in the industry, we remain optimistic about offshore wind and its role in the energy transition. We are actively building out our offshore business and have a nascent backlog that we are working to flow. We have had direct discussions with customers on both sides of the Atlantic who are preparing for the next decade. We want to establish a respectable and profitable presence in the offshore wind market. In terms of onshore, we are making great progress. Our selectivity and focus on improving the quality of our backlog has paid off. Our team has done an excellent job executing our power playbook and addressing the quality issues that led to a charge in the third quarter of last year. Our cost base has improved by 30% in just 12 months. We are also pleased with our grid business, as grid modernization is increasingly recognized as critical to the energy transition. Overall, we have a strong position in renewables with three aerospace angles of attack: offshore wind, onshore wind, and gas. We are confident in our strategy and believe we are well positioned for success at GE Vernova. JP Morgan Chase & Company analyst Seth Seifman inquired, what role do you expect pricing to play in offsetting the mixed headwinds for aerospace margin rate in the second half, and how can we measure the strong growth in spare parts going forward? Rahul Guy replied, in response to the question on pricing, I can confirm that we are price-cost positive both in the quarter and expect to be price-cost positive for the year. Our spare parts sales saw strong growth of more than 40% due to favorable customer mix, price increases and a weak comparison in China from last year. We anticipate continued growth in the second half of the year, although at a slower rate. Barclays analyst Julian Mitchell inquired, could you please explain the dynamics of the revenue uplift in renewables and how losses are expected to narrow in the second half of the year and into 2024? Larry Culp replied, Julian, I think you've got the key points right. We saw sequential improvement in onshore wind this year, which was our main focus. This was due to better backlog, pricing, terms and conditions, and improved market conditions. We're delivering a higher quality product to customers, reflected in our cost performance and restructuring. Our operating reviews give us confidence that the team is running the business as we want them to. We expect back half improvements and similar rollout in grid. Offshore wind is negating some of the progress, but we knew that was part of the startup. We feel good about the progress and momentum we're making at Vernova and renewables at large. Rahul Guy replied, so, Vernova is raising both revenue and profit guidance for the year. We're seeing a $150 million increase in profit from the midpoint, with power and renewables contributing to the growth. In the second quarter, power drove a third of that growth due to the strength of the services business. The remaining two-thirds came from renewables in the second half of 2023, with improvements in both onshore and grid. Onshore saw an increase in backlog margins, while grid saw an increase in volume and productivity. Overall, we've seen good progress year-over-year and on a sequential basis. Melius research analyst Rob Spingarn inquired, do you feel the need to get the LEAP 1 beyond to the A220 family to compete with the MAX 8? Larry Culp replied, Rob, I appreciate your multi-series coverage on the airframers and narroted product strategies. We are in close collaboration with both of our customers to ensure our product roadmap and technology roadmap, such as RISE, aligns with their own product strategies. Regarding the A22500, we will keep our comments private and have that conversation with Guillaume and his team. Ultimately, we want to be on all the critical platforms that will be important in the years to come. RBC Capital Markets analyst Dean Dre inquired, Larry, can you discuss the customer modifications within the recently booked renewable orders and how they impacted profitability? Larry Culp replied, thanks for your question, Dean. We've been working hard to be more selective in the types of opportunities we pursue and to offer more standardized offerings. This has had a positive effect on our order book, and we've also been conservative in our forward estimation of costs. We're confident that our quality improvements, coupled with our reduced cost structure, will lead to profitability in 2024. Vertical Research Partners analyst Jeff Sprague inquired, "What is your outlook for free cash flow and renewables for 2021 and 2024? Rahul Ghai replied, "Jeff, in 2023, we anticipate that renewables will remain relatively flat year over year with a positive earnings contribution of around 150 million. Onshore wind is doing well, but this is offset by the absence of progress payments and contract assets in offshore wind. In power, free cash flow is expected to be slightly down year over year due to the revenue growth exceeding billings. We anticipate strong sequential improvement in the business overall in 2024. Wolf Research analyst Nigel Coe inquired, "Carolina, could you please explain the $1 billion charge on the Polish bank and how it affects earnings and free cash flow? Does it involve writing down net asset value or cash, and does it clean up any litigation?" Rahul Ghai replied, "In Poland, we've been working to simplify our legacy liabilities and have approved a settlement program that significantly reduces our exposure to future losses. There is no additional GE cash required as the bank has adequate cash balances. This is a positive step forward in cleaning up and simplifying all the legacy liabilities." Steve Winokur replied, "And the 3Q question was just guide. Just how are we thinking about 3Q guide overall?" Rahul Ghai replied, "In the third quarter, we anticipate high single-digit revenue growth and an EPS range of 45 cents to 55 cents. This represents a 2x increase from last year, excluding any charges. Aerospace profits will be up sequentially, but margins may be slightly lower due to the majority of the increase coming from commercial oil. Renewables will continue to see sequential improvement, driven by onshore wind and grid performance. Power should also see good improvement due to outage activity. Our free cash flow was flat to slightly up in the quarter, despite headwinds from AD&A. This was due to earnings growth and working capital reduction." Citi analyst Andy Koplowitz inquired, "Could you provide more insight into the improvement in your defense business? You mentioned orders more than doubling and revenue up 31%. Has defense growth and profitability stabilized? What is the expected contribution to growth and margin over the next few quarters and into 2024? Is there an extended runway for defense growth?" Larry Culp replied, "Andy, demand is not our primary challenge in the defense sector. Our throughput is. We have experienced supply chain issues that have impacted our first quarter numbers. However, we are encouraged by recent improvements in material flow and yields in key operations. We have implemented a plan for every part, PFEP, to help us pull and turn improved deliveries. This has allowed us to better communicate our needs to both our internal and external supply base. We are seeing positive impacts from this, including traditional material price cost and labor productivity improvements. If we can continue to drive output levels, we should see a high single-digit top-line number, which will lead to margin and cash improvements." Rahul Ghai replied, "No, Larry. We're seeing a recovery in the second quarter that puts us back on track for the full year. Demand is good and we're seeing year-over-year improvement in delivery. We anticipate a strong second half of the year." Goldman Sachs analyst Joe Ritchie inquired, "What is your capital allocation strategy pre-spin and what progress have you made towards the spin?" Larry Culp replied, "Joe, our perspective on spend and capital allocation decisions between now and the launch of Vernova early next year remains unchanged. We're on track with the separation work and encouraged by the first half results and second half outlook. We still have a negative operating loss to address, but we're focused on sequential improvement business by business. Our priority is the successful spin of GE Vernova and stand-up of GE Aerospace, and we'll be in a position from a balance sheet perspective to launch and allow each board to shape their respective capital allocation policies." UBS analyst Chris Snyder inquired, "Can you explain the discrepancy between the first half revenue growth of 12% and the full-year guidance of high single-digit growth?" Rahul Ghai replied, "Chris, the orders this year don't have a major impact on our revenue. The revenue from these orders will be realized over the next 2 years. The difference between first half and second half growth is due to project timing. We are making good progress and have raised guidance on renewables and revenue growth. The orders are strong and will help our revenue in 2024 and 2025. Larry Culp replied, "Steve, I'm confident in our path ahead as we launch GE Aerospace and GE Vernova. We had a strong first half in 2023 and I'm optimistic about our future. Thank you for your time and investment in our company."